Everybody's talking about how to fix real estate. I mean, it just feels totally broken, right? Insanely expensive, and for so many people, completely out of reach. But what if the big solution everyone keeps pointing to is actually making things worse? Yeah, let's get into it.
And you've heard this a million times. I know you have. It's all over the news. It's all over your social feeds. The idea is always the same. To make housing affordable, the Fed has to cut interest rates. It sounds so simple, right? Cut rates, mortgages get cheaper, houses become affordable. It's the standard playbook.
But what if that's dead wrong? Seriously, what if cutting those rates actually does the opposite and makes housing even more expensive? That's the crazy idea we're going to dig into today.
Okay, so let's start with the problem itself. We're all feeling it, this housing affordability crisis. But to really get why the common fix might be broken, you have to see just how bad the situation has gotten.
All right, look at this. If you're trying to buy a house today, you're getting hit with a nasty 1-2 punch. It's not just that home prices themselves have gone through the roof compared to a few years ago. That's bad enough. But on top of that, the cost to even borrow the money, your mortgage rate, has also skyrocketed. So the price is higher and the loan is way more expensive. It's no wonder so many people are just completely locked out. So when you're faced with that nightmare scenario, of course, everyone's looking for the easy button, the obvious fix, and all eyes turn to the Federal Reserve. But here's the thing. The Fed doesn't have a magic wand that just lowers your mortgage payment. We need to be super clear about what they can and can't do.
And this right here is probably the most important thing to get. The Fed controls one thing directly, the Fed funds rate. Think of this as a short-term rate. It influences your credit card interest, your car loan. But a 30-year mortgage, that's a whole different beast. It doesn't listen to the Fed funds rate. It follows the long-term 10-year Treasury yield. That's set by the bond market, by traders. And mortgage rates pretty much just float about 1.5% to 2% above whatever that 10-year yield is doing. So bottom line, the Fed does not have a direct line to your mortgage company.
Okay, so this is where things get really weird and kind of backwards. Because if the Fed cuts its rate, the short-term one, you'd think everything else would follow, right? But if the bond market, the guys who actually set mortgage rates, get spooked by that cut, long-term rates can actually go up. Yeah, you heard me. Let's walk through how that can backfire. So let's play this out. Imagine the Fed finally gives in and cuts its short-term rate. What happens next? Well, the stock market probably loves it. Everyone gets excited. Economists call this animal spirits, this big wave of optimism and risk-taking. But the bond market, it sees something different. It sees all that excitement and thinks, uh-oh, this is going to spark more inflation. And to protect themselves from that future inflation, bond traders demand higher yields on long-term bonds. And boom, just like that, the 10-year yield goes up and 30-year mortgage rates go right up with it. So this is the paradox in a nutshell. What we all expect is on the left. Fed cuts rates, mortgage rates go down. Simple. But what can actually happen, the reality we might see, is on the right. The Fed cuts and mortgage rates go up. It seems totally backwards, but this isn't just some crazy theory. It's a real dynamic that can play out in the markets.
So how does a good thing like a rate cut lead to a bad thing like higher mortgage rates? It really comes down to one word: timing. See, if the Fed cuts rates when the economy is actually still doing pretty well, a preemptive cut, it's like pouring gasoline on a fire. It sparks this massive wave of optimism. That optimism makes the bond market freak out about inflation, and so the bond market reprices that risk by demanding higher rates on long-term loans, which, you guessed it, pushes mortgage rates higher.
All right, so if cutting the Fed's rate isn't the answer, then what is? Well, this is where we get to the real solution. And I'm going to warn you, it's unpopular. It's not what most people want to hear.
So, we're back to this fundamental question. If cutting the Fed's rate isn't the key, what on earth is?
Here it is, the real key. The only thing that really leads to sustainably affordable housing isn't lower Fed rates, it's lower asset prices. Yeah, things like the stock market needing to cool off. And I know that sounds completely unrelated, like what does my 401k have to do with my mortgage rate? But it's all connected.
And you don't have to take my word for it. The source material for this explainer puts it about as bluntly as you can. The only way that the long end, meaning long-term rates like mortgages, really goes down durably is to have lower asset prices. It's not a suggestion, it's presented as a market mechanic.
So let's connect the dots. How do lower asset prices actually help? Well, think about it. When the stock market falls, it's a huge flashing sign to the bond market that the economy is slowing down. When the economy slows, people spend less, which reduces the fear of future inflation. And once those inflation fears go away, the bond market can finally relax. They don't need to demand super high rates anymore. Long-term yields fall, and that is what brings mortgage rates down for real.
And this really brings us to the core issue. Why this is such a hard pill for people to swallow. Because this solution isn't free. It comes with a trade-off. A really tough one that most of us, honestly, don't want to make.
This is the psychological battle right here. On one hand, what do we all want? We want lower mortgage rates. We want our stock portfolios to go up. We want easy, painless solutions. But what's actually required to get those lower rates? According to this logic, it's lower asset prices, a weaker economy, and accepting some pretty difficult trade-offs. You see the problem? We want the prize, but we don't want to pay the price of admission.
So, get ready for a rerun, because here's a very plausible prediction. The Fed is probably going to cut rates at some point. The markets will go wild, they'll cheer, those animal spirits will be back in full force, and then we might just see long-term yields and mortgage rates tick right back up again. And it might take seeing that happen, maybe even a couple of times, before the evidence just becomes too obvious to ignore. Only then might everyone finally accept that this connection to asset prices is real.
Which leaves us with this one final, really challenging question. It's the whole point of this explainer, boiled down. To actually fix the housing market, does the stock market have to fall first? Are we willing to accept a drop in one area to get the relief we so badly need in another? That's a really tough trade-off, and it's something worth thinking about.